All right. So you have Matt Johns from Capita and me. I'm from Capita. My name is Zacc Call, and Kurt Brown from Townsquare Capital. Kurt Brown is the chief investment officer, founder of Townsquare, and Capita uses many, many of their models. We love what they do. We love their philosophy. And Kurt has this strange obsession with keeping track of exactly what's going on in many, many markets. It's really tough to get pretty, decent financial journalism out there these days. And we feel like what happens here in these quarterly reviews is we actually get to look at the data and have someone interpret the data, which is way different than the editorial we get on many news stations, depending on which way you go, right? So hopefully today you end up with some very clear information about what's going on in markets. We bring on Matt here in our office. Matt is the guy that we go to lunch and we can't get him to stop talking about stocks. And he's always got an idea, and he always has a stock that nobody's heard of. And then he knows all of the stats about the stock. And I can't figure out when he's doing this. Come to find out, it's late at night, and his wife hates it, I think. But yeah. You know what? We all love it, so we'll take it.
I'm in. The cell phone screen is too bright when you're in the bed with your wife, though, to be doing it. You've got to really dim the cell phone light. Kurt, I know you do it too. Look, yours is just economic charts. You're to the
Nobody wants to know about my charting habits at 1 a.m.
So, all right. So today, we've done this a couple different ways, and we tend to take questions as they go. So, throw questions in. I do want to make sure that we get through about the first 10, 15, 20 slides that Kurt has. We've gone over these before with Kurt, and I think that all of you will feel a lot of clarity around what's going on in the market, the good and the bad, if we can get through those. And then let's say at about 11:25 to 11:30, it's 11:05 right now. So in about 20, 25, 30 minutes, let's just take a barrage of questions and you guys fire away. And you know what? I'll keep track of what comes in. So if you've got the question on your mind and you want to throw it in the Q&A, do it. It is easier for me. I'll manage no matter what, but it is a little easier for me if you throw your question in the Q&A rather than the chat. And that way it gives me a system in which I can tick them off and make sure that we get to your question. So in other words, it's less likely to be missed by the ongoing conversation if you throw it in the Q&A. Just as we begin, we hope that you're all safe. It has been a crazy couple of weeks. I actually had COVID about a week and a half to 2 weeks ago. And it seems like everyone has it. My daughter just got a notification this morning that they're back to remote learning. I think the whole local high school has 140 cases right now. It's pretty prevalent out there with Omicron, and we hope that you're safe. The good news, of course, is that it seems as it has been less intense of a sickness for most people. But again, we hope you're safe. Stay careful. Most of our clients are, in the 50 to 70 range. It puts you a little bit at a target. Anyway, stay careful. We care about you. Hope that this today is really helpful for you. And I think we dive right in. Kurt, can you think of anything else to do or talk about beforehand?
No, man, I dropped my kids off at school this morning, and they told me there was 32 teachers called in sick.
Oh my gosh.
So I'm sure we're going to go remote any minute, like any second. I was like, yeah, I'm totally with you. All right, should we dive in? I like what you said. My wife's been a news reporter for her career, and financial journalism especially is not really about journalism. It's about driving fear so you'll watch, right? So we want to talk about both the good and the bad, and there's actually, believe it or not, plenty of both. So we'll have an interesting conversation here today. Let's start with the good stuff. The fundamentals of the economy, exceptional. Now, we can't always assume that's what the stock market's going to do, because remember, the markets look forward. They're forward discounting mechanisms. So a lot of times when markets are peaking, the news is the best because things have been excellent, but the market's actually trying to look and worry about what's coming next. We are total worriers in this business, right? When we're talking about our money, everybody likes to worry. Let's go through a few of the things. Okay, we always start with earnings. Earnings are the linchpin. These blue bars are the estimates of the S&P 500. I'm going to take this out of this mode here for a second, and hang on. I want to be able to draw. here. So I am going to, let's see if this will work. Okay. So here's what we're going to do. So I can scribble. The blue here, this is what earnings estimates are, but that first blue bar is about in the bag. That's about done. Look at the amount of earnings growth, even from before COVID. So you're going from $150 a share in the S&P 500 to well over 200 a share in a couple of quarters. That's unbelievable. It is massive earnings growth, Zacc. There's no way around this. Let's take COVID out. Let's just go 2 years. Okay, this goes back before COVID started. And in 2 years, US GDP is up 7%. A lot of times earnings growth in this country is about the same as GDP. But look at earnings growth compared to GDP in 2 years. 36% earnings growth. The 500 biggest corporations in this country grew their earnings by 36%. This is pre-COVID. This is not measuring from the bottom of COVID. So this is real, live, massive growth in earnings. And it's not just earnings. Look at sales. That is top line growth of the biggest companies in the world. You can't cheat this. Like, you can say whatever you want. There's plenty to hand wring about. We're going to talk about that stuff too. But you can't cheat genuine, powerful growth inside of our economy.
Hey, Kurt, real quick, can I add something to that last slide?
Yeah.
So people, I like to bring it home because I feel like many times we think the stock market is this crazy, like obscure and opaque thing that we can't fully understand. And when you really take it at its core, the stock market is a bunch of individual companies. And if we look at one individual company and we look at this chart, there's a story being told. Imagine you have a business that sells shoes. You could make more money one of two ways. You can sell more shoes, or you can figure out a way to make more on every shoe that you sell. And we're seeing that play out here. Now, the 16% sales number increasing means that overall, the shoe store is selling more shoes. But if earnings, and meaning if we make the same amount per shoe sold, earnings should also go up by 16%. But that's not what's happening here. We're seeing earnings go up 36%. So in other words, not only are businesses producing more, but they're actually making more per effort. They're making more per sale. The earnings are growing faster than the sales. So these are some good things that I don't think people are fully taking into consideration as they think about the stock market going up, and they say, you know what, the market can't keep going up. It can't keep going up. Well, you know, to a certain degree, it could. It's not going to go up every day, but the overall trend still can be positive because companies are making more money per effort, more money per sale. It's something to make sure we remember.
That's exactly right. And by the way, that's a great segue to the next slide. So this is what we call profit margins. So for every dollar that a company sells, Zacc, this is how much they keep. So this is after they've paid their cost of goods, right? The entire time I've worked on Wall Street. So this is a 30-year chart. By the way, this is almost precisely my career. I started in the business in 92. So ever since I got into this business, everybody has said, we cannot maintain this type of margin growth. Look at this. I mean, you're over 3x in 30 years. That's how much margins have continued to go up. I showed a chart, I think last time we were here, for every $1 million in sales, what does a corporation need in terms of humans? In 1990, the average company needed 8 human beings to generate $1 million in sales. It's 2 now, 2, right? So I saw a story the other night, Zacc, where a John Deere tractor harvested an entire field with no human beings, 100% on its own, remotely, through the cloud. The whole thing was done. Not a person out there in hundreds of acres. So when you think about the efficiency of business, this is one of the reasons that our economic expansion is so powerful, and why technology companies get so many props, you know?
And the question that came through here is, I think you're answering that right now. So we might as well just make sure we call it out. But the question is, are the earnings up in part because companies are charging us more for their product or services? That's an inflation concept. But we'll talk about that later, right? But this is more, their earnings are up because of that 8 people down to 2 people. Their costs are not as much per unit of sales. They're able to do it. think about, and also, Robert, it's a really good question, but think about in 1992 here, Bluetooth, Wi-Fi, portable computers, tablets, as much software that exists, apps. I mean, there's so much going on now that used to be done by someone writing something on a piece of paper in a checklist and taking it over to somebody else's desk and putting it in a bin. And so many things are automated now compared to then. So you think about how much has changed, and I do expect that we'll see technological changes in the future as well that also can create efficiencies and maybe fewer people per $1 million of revenue, for example. But anyway, the answer is really a matter of efficiency and the fact that they're charging more. So then the other question about this same concept is, are we going to see, if we're dropping the need for employees, where are people going to get jobs? It doesn't necessarily mean that that people won't have work to do. In fact, right now, especially, is a really tough labor market, which Kurt will go into more here in just the future. But it's not necessarily creating unemployment. It's creating a need for different types of jobs. And people need to learn better skills, and they have to be more knowledgeable.
That's exactly right. And you got to remember, it's not a zero-sum game. As the economy expands, we're just growing. But Zacc's right on. And we're going to let's talk about the labor thing right now. In fact, the labor market is absolutely smoking. It's insanely hot right now. Now, this US unemployment rate is a little bit misleading. So technically, by the government's data, we're back down to all-time tight labor market. But this is deceiving. And everyone knows this because you're all reading, right? So a lot of people have dropped out of the workforce. We had a lot of people taking early retirement, and they may or may not be retired. There's a lot of weird issues going on in the numbers. So we're not really at 3.9% unemployment. That's a government panacea. We're like at 5.5%, and we have some dislocation. Zacc makes it a great point. One of the problems that we have is that a lot of the people that are unemployed are not trained for where the jobs are. There's a massive amount of demand to hire people that are trained in technology, and there's millions of people not trained in technology that are unemployed, right? So we do have some misalignment, but the labor market itself is unbelievable.
Think about this.
Yeah, go ahead, Zacc.
Clients that are on as well. Think about this, like at Capita, we're hiring people. We actually doubled our team in the last about 18 months, and we're hiring people. But you guys don't want us out there hiring folks that we have to train from the ground up. We're hiring highly skilled individuals that come in with experience and that come in with knowledge and have 10 plus years in the industry and know what they're doing and are good at it. And that's tough for those people who haven't obtained those skills because they're not finding these same opportunities. In fact, the best employees we find, usually I have to go poach them from another firm because they already have a job and they already know what they're doing, and we want to teach them how to do it maybe a little bit better. But anyway, it gives you an idea of a weird labor market. It's like, for those who have jobs, there are a lot of opportunities. And for those who don't have jobs and don't have those skills, it's a really tough spot to be in.
Yeah. Some of you have read, you'll read about people quitting their job. This is another one of those funny things that in finance, we look at as great news about the economy. It seems backwards, but people quit their jobs when they have high confidence that they will find another job. So in strong economies, people quit. So you see here in the financial crisis, nobody quits. In the middle of COVID, nobody quits, right? Well, we are making new all-time highs in the number of people quitting their job. So that's actually incredibly bullish. One of the reasons I love data like this is you can't cheat it. The government can't lie about it, and CNBC can't spin it. I love data that nobody can screw with. And this is one of those things. If people are quitting their job, there's a lot of confidence out there, okay? Here's another one. Nobody's laying anybody off. Nobody's filing for unemployment with the government right now. They got fired. They didn't have a job maybe, but they're not getting fired because to Zacc's point, he's not letting his people go. I'm not letting my people go, right? Here's another stunning piece of data. It's completely unheard of. The number of job openings in this country right now. You can't fake this. This is a real, live, surging, thriving corporate environment right now. say whatever we want to say about things that we're going to talk about in a second that scare the heck out of us, but the data doesn't lie. And so you guys turn on the nightly news and everybody's hand wringing, the world's coming to an end and everybody hates each other and everything is terrible. It is not the data in any way, shape, or form. I'll give you another piece of good news, is that because of a couple factors. One is interest rates are very low. You can borrow money very inexpensively. If you have a high credit score, you've got a mortgage now under 3.5%. Unbelievable, unheard of in all of the history of the world. But there's other factors. You probably have built up cash. The value of your assets have gone up. Okay, look at household net worth compared to the right before the financial crisis started. So in 14 years, the average household in this country has more than doubled their net worth in 14 years. That's incredible. That's a stunning number. And meantime, interest rates go down. Oh, and by the way, we have a whole generation of people that don't want debt. They don't like debt. So what's happened is that the debt service ratio of the average household is still sitting right near its low, almost 100-year low in the amount of cost for you to pay your debt on a monthly basis. That's incredible.
Hey, Kurt, you're talking about which generation? Because I know this generation of baby boomers doesn't love the concept of debt, but if I'm not mistaken, you're talking about this next coming generation that's not really super interested in taking on debt. Is that what when you say this generation, who are we talking about?
People just don't want to borrow. You know, people that have been through the financial crisis. You know, it's 13 years ago now, the financial crisis. If you lived it and you had money, you had investments, you owned homes, you are hurting. Like in your soul, you may have made all that money back and a lot more, but in your soul, you feel October of 2008. Like we all feel that in here. And it has really changed people's borrowing habits. I'll show you a chart on that in just a second on what I'm talking about. But
before we leave this, I want you to clarify these numbers here in blue that you've circled on the bottom chart. Is that per household, that 70,000 and the 150? So folks, I talk to you regularly in meetings, and I'll be talking to someone that has $500,000, $1 million, $2 million, $3 million, and I'll tell them how fantastic they're doing from a savings standpoint. And they're like, oh, I just don't have enough. Look, these are the actual averages out there. I just want you to take a minute, because pretty much everyone on this call is doing really, really well when it comes to having a high household net worth. And we're biased because we only talk to people like you. But look at that. Like, look at how well you're doing, and know that it's not that way for everybody else out there.
Yeah, that's right. And you should know that at any given point, between 40 and 45% of the United States doesn't have enough money in the bank to live for 30 to 90 days. You know, so you're right, Zacc. Most of your clients have done very well in relation to the rest of the country. I mean, couple of the things that you might find interesting. We've done a lot of hand wringing about the supply chain. We all know, I'm not going to beat that dead horse here. And here's all the things that screwed up our supply chain coming out of COVID, right? All that pent up demand. Nobody spent money for 9 months. Massive stimulus, you know, pouring gas on the fire. The global economy is back and hot. There's no supply. All the Chinese factories closed for 6 months. There was no supply, right? There's less workers, like you name it. Okay. So in the middle of that, what shocks people is look at the amount of Chinese exports. Okay, this is where we were. The global economy was consolidating here from 2015, Zacc. So for 5 years going into COVID, we were consolidating. Chinese exports, by the way, they're the biggest exporter in the world by a country mile. They touch 40% of the world's goods. I mean, so this is why we look at Chinese export data. It's so critical. But look what happened. We've exploded out of that range we were in. And look at where Chinese exports are coming in at. Like they are full throttle. So you want to know why it's been hard to get things? It's all the factors in red, and then all-time high in the amount of shipping that they're doing off their shores. Like it was a perfect storm. Okay. One of the great leading indicators is something most of you have never heard of. It's called the Baltic Dry Index. It's this weird, it's what shipping companies use between each other in how they price moving things like grain, steel, oil, etc. It's an index of those big ships that go out on sea, not the ones that carry containers, but the ones that carry raw materials inside of them, okay? And it's plunging from where it was. It's usually a pretty good leading indicator of what is going to happen next. And a lot of times in the past, it's indicated we might go into a recession because there's a slowdown in people trying to ship in the ships. What it probably means here is we're just getting back to normal, is what it means here. We went through this insane period where you could not get your hands on a ship. So we think we're about to really start to normalize here. Christmas was actually surprisingly slower for retailers than people were expecting. It was a little slow. And we're kind of seeing in January some slowing. If you look at Visa and MasterCard swipes, they're down. So we're probably about to enter a more normal period again. We're probably finally going to go out. Even the auto manufacturers, Zacc, are starting to put up incentives for ordering a new car. They were not doing that for a year and a half. Now they're back to saying, and what does that tell you? They know what they have coming off the assembly line, and they're starting to put out incentives again. These things are really good signs. A lot of times in the past, that would be almost concerning. We needed this. We needed some breathing room and some normalization in the supply chain.
One thing
Hey,
I'm going to say that
Matt, go ahead.
I was just going to chime in here only because COVID becomes an issue here. China's policies with COVID, I think this is why it's kind of been more of a stir when it comes to political landscapes and concerns. Is we look at this and we know China is exporting a lot. We're consuming a ton of that here in the United States. Well, they've got a COVID policy where they have like a zero COVID policy, which I mean, I don't know if you can fact check the Chinese government, but it's probably not able to. But I think one of the concerns, even though everything Kurt's saying is spot on, when you talk about why is COVID, this particular strand, being strenuous on the economy, it's because, well, if China has a zero tolerance with it, it could impact how they are able to execute on their exports, which are vital to the rest of the world being able to keep inflation more level. Yeah. So I put that little wrinkle in there, not to like try to confuse you and certainly not to contradict, but just more so to say, like, I think this is one of the ripples of COVID is when countries have really stringent policies on how they are going to treat it, it can send a ripple economically.
And they are trying. It's such a great point Matt makes. This would really be problematic if they shuttle these factories down again. I think that's what Matt's saying. I mean, it would really be
correct.
You know, I have a really dear friend of mine who runs a big hedge fund in Hong Kong, and we talk all the time. He was actually here a week and a half ago. We did some lunch together. He has said that the Chinese really got hurt when they shut everything down, and they are doing everything they can not to do that again. Even some weird stuff like rounding people up that have COVID and putting them in camps. Yeah. I don't know if that's true, but that's what they're hearing. So they don't have to close the factories because they got hurt so badly when they closed the factories, you know? So
I'm gonna give everybody a little bit of terminology here. I feel like sometimes my job is to be the anchor that helps, like the weight behind you guys moving so fast. I'm gonna give everybody that when Kurt says consolidating, that term in the industry means that the prices, like as you look at this chart here where Kurt has drawn the horizontal red line and talked about those prices consolidating, what we're talking about here is the various outputs of the data coming together. It's the outputs of the data consolidating into a tighter band and then a breakthrough after that. So anytime you hear a particular market or the labor market or exports are all consolidating, don't take it literally that activity out there is consolidating. Take it as the data is coming together and we're seeing it result in a tighter band. And then it may break out to the up or down. But anyway, that hopefully helps everybody understand what we mean when we're talking about consolidating data and then a spike out.
That's a great point. That's an absolutely great point. What we're almost talking about is a normalization. Look how low it dipped, and now it's peaking. And you probably, a better way of saying it is you're coming back to the trend line. You know, you're sort of reverting to the mean, if you like math, or however you like to say it. But yeah, it's a great point, Zacc. A great point. A couple of the things, and then we'll go to the negative stuff. Personal savings is back down to where it was before because the stimulus has come off. But what I will say is if you look from January 20, This is the amount that we estimate is excess. So what happens is all economies, when they're kind of normal, Americans are saving a certain amount, right? There's based on the savings rate, right? So if there's a 7% savings rate, there's a corresponding amount of cash that we have put away as Americans in the bank. Right now, there's almost $2.5 trillion in extra cash above that. So there's a lot of cash that's sitting out there on the sidelines, like a lot. Let me show you another way of looking at this.
Pause real quick, Kurt, because I know I keep jumping in. Go back to that last slide. The reason I think this is important is we talked about the number of jobs that are available for people to go and work. So this one on the left, I don't think is emphasized enough about how positive that is from a standpoint of personal savings of disposable income. This is basically saying people are going to need to start getting back to work. And you're sitting there going, why does that matter? Well, we know we've been combating some inflation taking place. Well, a big thing that's actually good for the markets is when we have GDP growth, that's gross domestic product. So that's how they measure the growth of the economy. So when we can have growth taking place in the economy in some inflation, it's not a negative. It's when we don't have growth in the economy and we have inflation that we can have, it's called stagflation, that can be a negative. So I'm pointing this out, not hopefully to confuse everyone, but more so to say, this is really big because we just saw 11 million jobs are available for these people that are having their amount of income go down or disposable income. That means the opportunity for them to go work or get a different job and maybe make more money is up. And as more of those jobs are filled, that's going to increase production. Production is 60% of gross domestic product, the calculation, how much we can produce as an economy. So if we can get more people to work, we can produce more. If we produce more, our economy is going to grow. And if we have that paired with inflation, it's positive for the markets. So just chime in there just because that's one of those, that's a really cool chart from a standpoint of saying, hey, they still have cash. It's okay, disposable. This might encourage some activity naturally to take place in the economy that's really positive for growth.
That's right. And this is just household. And the S&P 500 companies look the same. They're holding about 30% more cash than they ever have before. So you're right, Matt. Everybody's got a lot more cash. Why do I obsess about this? Cash is king. You've kind of heard that phrase before. Economies love cash. Why? What Matt just said, it's probably going to be used to invest. People don't sit on insane amounts of cash, especially in inflationary times. They need to invest it somewhere. Stock market, bond market, businesses, real estate, whatever they buy, right? The second thing, though, is cash cures a lot of ills. So cash-rich economies weather recessions better, right? Think about it. Like if you go into a recession, people get laid off, companies struggle. The cash is out there to buy time to fix the economy. 2008 was so nasty because there wasn't a lot of cash. We went through a period where no one was saving. So when 2008 hit, no one had money. It was all tied up in real estate. It was all tied up in investments, and people panicked. If we went into a recession right now, okay, there's trillions in cash sitting out there. We can weather that storm. So Matt's spot on. It really provides a nice tailwind to sort of what's going on. Here's more data on this. This is mind-blowing. Cash balances at U.S. banks, 4 times higher than pre-COVID. Like, think about that. That's how much cash is sitting out there. Now, it is skewed. Okay, look at this chart on the right. So you look at the cash balance jump coming out of COVID, okay, in just checking accounts in the United States. It's not the bottom 50% of the country. That's the group that doesn't have the cash. They got stimulus. They were able to put a little more weight. This is not where the movement's been. In the top 50% of net worth and income in this country, an explosion. And look at the top 10%. The top 10% wealthiest people in this country are sitting on mountains of cash. Let's go back to Matt's point. Who does most investing in the United States? It's the top 10 to 20% of people. By the way, you on this call are in that group. And that's who invests. You invest in stocks, bonds, real estate, but you invest in businesses. You build businesses and things like that. And that's why this is so good for the economy. Here's the data we just got late last week from JP Morgan and Wells Fargo. Look, loans up a little bit, deposits up a lot, even still, even in Q4. So it shows you that people are still being a little defensive in how they're approaching their finances. and usually when we're feeling defensive, the market's not about to blow up. That's usually the way it is. It's usually when people feel aggressive and emboldened and, cocky. That's usually when markets blow up. One more slide on this. For 40 years, if a bank brought in money, if they brought deposits in, they lent them out. That's not the case anymore. Deposits are skyrocketing and they're stalling in their lending. By the way, 2 reasons. There's no demand. A lot of people don't want to borrow money, even if they can borrow money. And the second reason is they're not going to lend to the subprime like they used to. Banks don't lend to bad borrowers the way that they used to, right? They learned their lesson. I'm going to skip this thing on the right here. Okay. Housing. I don't want to beat a dead horse. We've talked about this before. Bottom line on housing, I'll say it again. We get this data every quarter, is the vast majority of the mortgages that are being originated are going to the highest credit scores. Okay. This is still a cash rich and high credit quality real estate boom. Unlike what was going on here going into the financial crisis, where a massive percentage of the mortgages were to the lower credit scores. So are prices too high? I don't know. I don't know what's going to happen to prices in real estate. I suspect nobody knows, right? But the foundation that's been built is exactly the opposite of 2008. This is not 08. Regardless of what the prices are doing, we're not in an 08. Look at the debt. In the whole United States, mortgage debt is the same as it was in 2007. That's ridiculous. But look at the value of the real estate and what it's done in those years, right? So this is not a debt-fueled real estate rally. That's super important. We think we're going to see a stall in housing prices in the broader United States because wages are not keeping up with the price of real estate. People are getting pinched. It's too hard. And people feel really bad. This is University of Michigan sentiment around buying houses. It's the worst record. It's by far the worst data ever recorded. People are just downright hostile at what it costs to buy a house right now. You're probably going to see a little cooling in real estate going forward. I don't know, Matt, Zach, you guys want to add anything on that or not?
No, I think everybody's feeling it from a standpoint, and part of that cooling you're probably going to get into as well. Aside from the wage, those interest rates are likely going to move a little bit. And so you'll have the culmination of those two that would support that thesis.
Yeah. Oftentimes people say housing won't continue the way that it has, or that we talk about that word consolidation in pricing or revert back to the mean. The thing I want all of the listeners to understand here is there's a difference between housing prices dropping and housing prices not going up as fast. So sometimes I'll have someone out there saying, you know what, I'm going to wait for the real estate market to cool before I buy, or I'm going to wait for this opportunity when it drops. And they never actually get the opportunity. And they don't get the opportunity because even though the market slowed down and it's not as hot as it was before, the housing prices went up. They just went up less fast. And I'm not trying to say that housing will always go up. I actually think there's an opportunity potentially that they would go down. But if I'm placing my own bet, especially on buying a primary residence, I'm not trying to time it and say I'm going to get a better opportunity in the future, because the reality is you may not. And just personally, I feel like I've gotten taken on every house I've ever purchased. It's just the way that I always feel. And then a year or 2 or 3 later,
hold on. That's because he bought the home. What was it? The first one you and Michelle bought? It was.
We bought in 2007.
Yeah.
And then the market dropped, right?
I mean,
and
point
then
that time out right here on the mortgage debt consumption. Point that out. He bought right there.
Very true. Very true. And that house was a condo we bought for $165. And then at the bottom of the recession, they were short selling for $90. And man, was that brutal on a young newlyweds, right? And then in 2010, we bought another home and I thought I was getting taken there. We paid $346 for it and we sold it a decade later for $650. And the point I'm trying to make here is that I thought I was getting taken at $346 in 2010, and we never saw that price again. The market sped up and cooled and sped up and cooled, but it never went back down to $346. It just climbed from there. And this happens in stocks. It happens in real estate. It happens in any asset class where you're owning equity. Sometimes people will miss out on 50% gains to try to wait for a 10% drop. Don't let that mental fallacy hit you, is what I'm saying.
Yeah. You know, there's another interesting thing. and most people have seen these charts, but if you go from a 6% mortgage down to a 3.5% mortgage, you actually can get almost twice the house for the same monthly payment. It blows people's minds. And here's the data right here. Mortgage debt service in the United States as a percentage of your disposable income, new all-time low. New all-time low. Even though the prices have skyrocketed, people are making more money and the interest rates are so low that the mortgage payments haven't gone up the same way, right? So we've been able to cure a lot of ills. Now this will work in reverse if interest rates really start to go up. And we're all nervous about that, right? If interest rates really start to go up now, it's really going to cool off the housing market because it's going to make it really hard for people to buy. It's why the Fed's going to be in a little bit of a box. Fed's got to be careful how they raise rates. We can talk about that more in a minute. So Zacc, do you want to take questions or do you want to move into what scares us?
I've been watching questions. We haven't had any come through, folks. If you have questions about that first segment, we basically talked about what's good. Let us know. I think most people want to jump right into what you're worried about. So I would say throw questions in. I'll be watching.
Yeah, bring the questions.
But let's talk about what is something you're concerned about or how you feel about it right now.
Yeah. Okay. So let's go through a few and fire your questions as we go here, Zacc, and you can just cut me off. But there are some things that I don't like, I'm more worried than I was 6 quarters ago. Let's put it that way. 6 quarters ago, everyone thought the world was ending. We don't think that anymore. And remember, there are 2 great times to buy assets, Zacc. 2 great times. When things are cheap, that's a great time to invest in things. Or when everybody hates something good, that's a great time. I'm not seeing a lot of either right now. I'm not seeing a lot of hatred, and I'm not seeing anything cheap, right? So the stock market is still pretty expensive. This goes back to the mid 90s, and we're still in that upper band of how expensive stocks are. They aren't cheap. And I could show you charts like this for real estate. By the way, bonds aren't cheap. Bonds are expensive. They're way up with interest rates. There is nothing cheap because there's cash everywhere and we're in a booming economy and it stresses me out. I like buying things that are cheap. Now, big giant asterisk, okay? Markets don't go down because they're expensive. That's not what makes markets go down. There's reams of data showing that real estate and stocks and all kinds of things can stay expensive for years if the fundamentals of the economy are really good. It's other things that make asset prices go down, not just that they're expensive. But I don't like this. There's less margin for error when things are expensive, right? We've talked about this in the past. I'm not going to beat a dead horse here, but we all know about these zombie companies. We've talked about this every quarter. There's a lot of companies out there that are alive that should not be alive. They are living on borrowing, okay? It depends on the math that you use, but it's somewhere between 15 and 20% of publicly traded companies. Their profits don't cover their debt payments. They need to keep borrowing just to stay alive. I don't like that. In the early 90s, it was a fraction of that, right? With low interest rates and lots of cash out there, dead companies are being propped up. And if we go into a nasty recession, okay, there's gonna be a lot of bankruptcies. Don't like that. Okay, here's another way of looking at this. This is Zacc is the weakest 20% of publicly traded companies and what their interest coverage ratio is. It's another way of looking at zombie companies, but we're only going to focus on the weakest 20%. Okay. In the .com, it was awful. It was the worst you can imagine because all these companies were coming public with 0 earnings. In fact, a lot of them came public with 0 sales. Okay. So, but look at 08. The 20% of weakest companies today are worse than at the bottom of the financial crisis.
And to help people understand this interest coverage ratio, we're talking about how much you can see on the left, it says EBIT, EBIT, earnings before interest and taxes. So you're talking about their earnings, and then you're comparing that to their interest cost, their debt cost. And if you say, if they have $1 of earnings and they have $1 of interest cost, they're at 0. And that's that line across the middle. So anything below the 0 mark means they have more debt cost than they have earnings. And above the 0 mark means they're one of those, like you compare it to a personal household. You're thinking these people are making $50,000 and their credit card debt payments are $50,000. That's every year. That's what we're talking about here. And that's the scary part about some of these companies is that they have to pay more than their credit card payments.
Yeah.
Than their income. Sorry, I meant to say. Go ahead.
That's right. That's right. So anyways, I don't like this. And so be careful. We're going to hit this hard at the end, but I'm going to start now. Know what you own. Know what you own. Don't own crap. Know what you own. I said this 90 days ago on our last call, Zacc. The worst investments in history are made when people feel good. Feeling cocky is the worst thing you can feel for investing. So when you feel great, be very careful. This is the time, as great as everything is that I just showed you, this is the time to be extra careful about what you're investing in. There's more little landmines out there because in good times, the weak and the dead get carried along. And then in the next recession, they blow up and they go away. Just know what you own and right now fix your portfolio. And I'm not talking just your stock portfolio. You know that thing you invested in that your uncle brought to you 4 years ago? That like weird thing that you invested in? Get out of it if you don't like it. Like,
or if you don't understand it, right?
You don't understand. And honestly, if it's not thriving in one of the greatest economies ever, it's not going to thrive. So right now, sell it to some other sucker, right? This is the time to improve your portfolio, okay? Is when everything is good, right? So I'll shut up about that. Okay. The stock market is doing both a weird and wonderful thing at the same time. We're not down very far from our highs. We're having an ugly day today. I can see it on my screen here. There's a lot of red out there. In the last couple of weeks, the market's been under a little bit of pressure. Okay, but here, want to see something crazy? If you look at the NASDAQ composite, right, a couple thousand companies, 68% of the NASDAQ stocks, by the way, this is a week old now, are down 20% or more from their high, and 40% of them are down 50% or more from their high. Okay, the reason this is bad is there's a lot of junky, garbage companies out there that are being taken out to the woodshed. People are getting wise about that. Now, the good silver lining of this, though, is the market as a whole actually holds up incredibly well while we're taking the dead wood out. And think about the last year. We've taken the SPACs out and shot them. We took the meme stocks out and shot them, right? Now we're taking the software companies that are small caps that have no earnings of any kind, and they're taken out and getting shot, right? And the market actually holds up pretty good. We like seeing this. What we call it in our business is a rolling correction. Instead of the whole market plunging simultaneously, every few months, a different sector is being cleaned up of its own accord.
But what makes that?
Go ahead, Zacc.
You want that, right? I mean, you want that to happen. Yeah. In fact, it's better for that to happen that way than to have to deal with it all at once. But we do want these companies to be cleaned out periodically. And from my standpoint, since we talk to the individual investors, I can't stand when there's all this excitement about GameStop and AMC and SPACs and all the different, all the different companies out there. And SPAC is the idea where somebody says, let's create a business. We don't know what it is yet, but let's put a bunch of money together and create this special purpose acquisition company. And we'll go and just buy a private company and immediately it will become public instead of having to go through the normal process of being public. Super exciting, really interesting. It's been around for a long time, but it's caught a lot of steam in the last year or two. But I've seen a lot of clients get burned and stuff like that. And anyway, it's good to have this cleansing process that happens regularly.
And here's what I'm fearing. What I'm fearing is the next ones to be cleaned up are the generals. Okay, the generals, the big boys. They call them the FANG stocks or whatever. They're down here at the bottom. Facebook, Amazon, Apple, Netflix, Google, Microsoft. You can add Tesla, add, NVIDIA, add all these big, high-flying, by the way, excellent companies, best in the world. And they have been dominating I don't want to go way into this chart, but look at this here. Apple's shares are $3 trillion in shares. It's worth more. Walmart, Disney, Netflix, Nike, look at the list. Apple's worth more than all of those companies combined. The market is getting very, very top heavy, okay? Look, the top 10 stocks in the S&P 500 are trading at 33 times forward earnings. It's pricing in 33% per year growth of the top 10 companies in the S&P 500, man. That's a tall order. You have set the bar very, very high. Another way of saying this is there's nothing wrong with the fundamentals of these companies, but they are pricing in perfection. And so Zacc is spot on. I know it sounds counterintuitive. One of the healthiest things that could happen to this market right now is a correction. This market needs a little air taken out of it. We need to get a little of the euphoria maybe bled out of it. And let me explain why. When you get a market that's too hot, people are too enthusiastic, really bad and dumb things start happening that creates accidents in the market. The financial crisis was created because of a 5-year window of reckless, aggressive cockiness that then collapses in on itself. So we need a market that is disciplined. You want it up, but if people get too excited and too euphoric, it can collapse back down on itself. So we actually need to let some steam out as we go. Zacc said it really, really well. And we're seeing it. Since October, the market is slowly letting air out of itself underneath the hood. And I really like it. I like this pin action. And by the way, if the market drops 10%, it's not going to break my heart whatsoever. We almost need a little bit of a cooling period. I know that's not popular to say, but we almost kind of need it, Zacc.
Most people don't know that it drops about 15% every year anyway. And so
that's
just normal. They just don't notice it because they don't look at it that frequently. Will you hang on this slide for a second? We have a couple questions that I think that apply to this particular slide.
Yeah,
so,
let me go back to that.
So
here, let me right there.
Yeah, this one and then the next one. Yep, you got it. So then the first question is, the folks here are relying on Capita and our partners to help us choose what companies we're in. How does Capita help stay out of zombie companies? So there's two ways that this happens. One is that when we use individual stock selection, the managers that are doing that will emphasize high quality, and they have metrics like interest coverage ratio that we talked about. There's another one called current ratio, which shows how much cash they have compared to 1 year's worth of debt service. And then also you can look at earnings growth. How much are their earnings increasing every year? And so what we want to find is companies that have really solid quality metrics, low debt and high earnings. And the managers that we've selected across the board and that we use through Townsquare they tend to have a little bit of a growth tilt like that. They also tend to be pretty quality biased. They're more concerned about getting fired when the market's down than they are about crazy high growth on the upside. So keep that in mind. That's one way. And then the second way, most of our portfolios are a combination of two different things. You've got some individual stock security where we're picking individual stocks and really highlighting quality investments there. Or we're very diversified through low-cost index funds. Now, inside those index funds, you're getting a little bit of everything. What tends to happen with that is the larger companies in those index funds tend to dominate the allocation. So a lot of the smaller and less successful businesses tend to become either lower weightings or they're already start at lower weightings. And so you have this natural process. Also, the diversification of those index funds and those broad portfolios, and you're probably familiar with seeing the word cornerstone in a lot of your online profiles. Those are what provide a really steady return in the portfolio without making bets. And it's worked really well. I mean, those cornerstone models have outperformed a lot of the stock pickers over the last year or so. And then the year or two prior to that, the stock pickers outperformed the cornerstone models. So it's that barbell approach of using the two different theories that help in various markets and help us avoid those.
And Zacc, I'm going to chime in here as well, because this is something cool that Kurt and the team do. Even within our allocation models that we end up using that you're talking about, if there's an opportunity, even though we like to be passive in those, if there's an opportunity where they need to be active to try to eliminate exposure to those, we're going to do it. Even if that means it's going to be passing on a little more cost on a per average basis. And so there's one investment in here, example for a dividend wisdom tree fund that we use, and we use, Kurt, I'm kind of putting words in your mouth here, but I'm anticipating we use it in part because we're trying to eliminate exposure to some of these bad companies, even within that broad portfolio. So it's kind of twofold in the way we're doing it. It's the way in which we select how we invest the diversified portfolio. And then it's also using the active managers that try to help do that. But yeah, definitely relying on us. And we definitely know that.
The second question, go ahead, Kurt.
Well, let me add one thing on what you said, Zacc, that's so important. I'm gonna up the ante. So I spent 13 years as a fund manager in New York, a large cap growth fund. Okay. And there were windows of time that I actually wanted to underperform the market. I know this is going to sound really odd, but if you're going to decide and commit to owning high quality assets, there's going to be these windows of time where maybe people are getting euphoric about less quality assets. 1 year ago, from January to March of last year, there was a window that was like this. Everybody was chasing junky, garbage, hot, headline type companies. Let's say you got to the end of the year last year, and let's say you look and saw the stock market was up 27% on the year, and your portfolio was only up 17% on the year. That may actually have been a huge win, because your portfolio that you're wanting needs to be, and you want it to necessarily be, less risky, higher quality assets, etc. So when I ran my fund this way in 2008, there was a point where the market was down 50% and my fund was only down 24%. Okay. That's the trade-off there are times you're going to make. So remember, the headline of the stock market as a generic mechanism is not necessarily even what you want. And that's why we to Zacc's point, we really commit to quality, because the next time I go into a recession, my companies aren't going bankrupt. And I take times where I maybe don't do quite as well in exchange for that. So I thought I'd throw that out there, Zacc.
That's good. Okay, so pricing in perfection, you mentioned that, and I want to touch on it, and then maybe Kurt, you add to it. My interpretation, because the question is, what is pricing in perfection?
Yeah.
And we use that term a lot, and all that means to us is that the market has said these companies are so successful, and they're going to be so successful in the future. And when we say the market has said it, what we really mean is that people have put their money where their mouth is, and the prices are now high enough that if they don't perform that well, the stock price will come down, because it's anticipating, like Kurt said earlier, maybe a 30% average annual increase on the stocks on their earnings over the next several years. So if maybe Apple doesn't perform at that high of a growth rate, the current price of the stock of Apple, the actual price, might come down to account for the fact that everybody already guessed it would do that well. So that's pricing in perfection. It makes stock picking difficult, because it makes the managers have to say, well, shoot, everybody's anticipating this is going to be perfect, that we won't have any external risks that bring markets down. Are these companies trading at 30 times their earnings and more? Are they really going to perform perfectly? Because if they perform perfectly, I get a reasonable rate of return. And if they don't perform perfectly, I might actually lose money. So that's the hard part about when it says pricing in perfection, which is why a lot of managers will actually avoid. I mean, I know a lot of money managers who have wanted to own Amazon for a long time, but felt like that Amazon's price was pricing in perfection, and so they just couldn't bring themselves to buy it. Now, Amazon did better in terms of their earnings growth than what a lot of people thought perfection was. So the price kept going up. And
That's
so
right.
It's tough. It's just a tough game, and it's
look at this.
Tough work.
Okay, you see the blue bars here. The blue bars are the earnings for the S&P 500 companies in 2021, 2022, and 2023. 2021 is about to no longer be a blue. It's about to be a green, right? Because it's in the bag. But look at how much growth analysts are pricing in. So we're pricing in this stellar explosion of earnings growth. What if it doesn't happen? What if the blue bars start coming down? Then stocks are too expensive. That's the bottom line. So when we say pricing in perfection, we are pricing in this really high growth rate to last for a couple more years, right? So Zacc is spot on. It's a great explanation, Zacc.
And the hard part is we've been pricing in perfection for many years, right? And we've had darn near perfection, with the exception of the COVID crisis that only lasted for, I know COVID's still around, but I mean the market pricing effect of COVID only lasted, it seemed, for 3 to 9 months. And then it was erased at most. And so it's just a tough battle, because if you start saying, well, markets are priced in for perfection, I'm going to get more conservative, you might miss out on a stretch that we don't know how long markets could continue at that level, meaning how long companies could continue to be that successful.
Hey, I just looked at the clock. We're going to be up against the hour. So do you want me to jump to that summary slide right at the end?
Let's do it. Yep, let's do it.
Okay, we were going to talk about inflation and stuff, and that's a topic that's getting a lot of run. And by the way, I'm happy to stick around for a few minutes and answer people's questions. Zacc.
Why don't we do that? And we spent almost the entire hour on inflation last time, and so
yes.
it hasn't changed that much in terms of. So if you want, go back and listen to the other one. I really wanted to make sure that we didn't spend the whole hour on inflation today, because there's so much here that we needed to cover as well. So I'm happy the way it's turned out. Do our summary here, and then after that, we'll just answer as many questions as we can.
And some of this we've already touched on. So Zacc and Matt and their team at Capita are, and I work with a lot of people in this industry. We manage billions of dollars for people around the country. They are as good as it gets at being disciplined about rebalancing. Most of you know that. When times are bad and good, you have to have the discipline to do some rebalancing. So you have to be willing to sell a little bit when times are great, and you have to be willing to buy a little bit when maybe things are not going very well, like during COVID. But you got to be disciplined about that. Sell when you can, not when you have to. So this may be a great time to take a little bit off the table and then maybe buy some assets that maybe have not done so well. This is a big one. You got to avoid complacency. I already said it. This is where Uncle Bob put you in some crazy investment. This is stay disciplined. Stay on top of it. Know what you own, right? Don't just blindly buy assets because, somebody told you they're buying this stock and it's going up. People make really bad decisions when they just blindly do things, and then know why you own it. I talked about this. Like, your portfolio might not be the S&P 500. Mine's not. And I've been in the industry 29 years. Mine's not the S&P 500, right? For a very specific reason. I'm trying to build a portfolio for me and the outcome that I need. So know why you own something. When somebody says to you, this is a great investment, I don't even know what that means. Great for who? Great for my grandmother or great for my 8-year-old in his 529 plan? I don't know. You have to drill deeper, right? We have a bias toward owning high quality assets. I want to avoid what's going to blow up in the next recession. And I'm willing to make a little bit less money in the meantime, if that's what that means, to be sure I own really high quality assets. Zacc talked about it earlier. I had a chart in here. The market drops 14% a year, every year, for 100 years. That's the average, right? Sometimes it's a 30% drop, sometimes it's 5%, but expect volatility. There's going to be more volatility. And in the past 2 weeks, we're seeing a little bit of it. Maybe barbell your approach more. Don't sell your growth assets. Your Apple stock is expensive, but you maybe don't want to be out of it, but maybe hold a little bit more cash and maybe even some boring bonds. Zacc's very good at this.
Are you saying I'm boring, Kurt? What?
No, you're good at making people hold a little rainy day money.
It's true.
And
just a little bit. He's a little bit boring. He's a little bit boring. But it's okay.
I'm not going to say he's the biggest Excel spreadsheet nerd I know, but he might be. And then maybe consider something that's a little bit outside the box. This is not right for everybody, but sometimes you can get into private investments. We call them alternative investments sometimes. And for certain people, that might make sense as well. Ask your financial advisors about that. But there are some ways to maybe diversify your portfolio even a little bit further. Matt, I don't know if you want to add anything to that list or not, but
yeah, no, I totally agree with it. I feel like a lot of my comments would end up being on the inflation front. Anytime I see something that I'm like, hey, I see speed bumps coming. Yeah. I'm like, and that's just partly the advisor in me, is because I know we're doing all these things, Kurt, that you're talking about, this list 1 through 8. Like we're that's why you have us, is for us to go through and do that. So I've got a great deal of conviction in clients' plans because we help put them together. The part that I feel bad about is sometimes people put a lot of trust in us and they don't develop the conviction themselves.
Right.
And so I think it's really important to know that these are appropriate questions. If you come in and you're like, I don't really know what I know, it's an appropriate time during a review to say, can we just try to dissect a little bit of what I own a little bit so that you can develop that conviction in what you're doing. I think that's the biggest thing, is if you can kind of do that, because we're going to help provide the infrastructure right here that we're talking about. But this is really important. So if one of these questions that Kurt's saying we should be doing, we feel like we're uncomfortable with, it's an appropriate question to say, hey, could we spend a minute and talk about it?
Let's do 2 things. We got 2 questions to touch on. And then maybe we depending on how long those take, maybe we touch on inflation just for a second and you give us your elevator speech on that, Kurt, as to what's going on right now. So be thinking about that while we do these 2 questions. And then after that, we'll probably wrap it up unless somebody else throws another question in here. Question first is, let's talk about Are aggressive world events by Russia, North Korea, China affecting the markets in any way in all that has been said today? What do you think, Kurt?
Robert, he hit the nail on the head. It's it. This is all the other stuff is relatively easy to model. And that right there is the question. And by the way, it's always out there. In my 29 years in the business, there's always these things out there, and you can't model for them. And the answer is absolutely yes.
More so than before, right? More so than before, because of the global economy. We have most of the businesses that are the biggest in the S&P 500 have sales and operations across the entire globe. So yeah, more so than before, Robert.
And you know what? I'm worried about what Russia's doing. I am. I don't know how to model it. I don't know how crazy they're going to get. It's like North Korea and China. This is a big deal. And by the way, when I talk about a market that's priced for perfection, the market is not pricing one of these things in. And if somebody gets really crazy, the Chinese someday are going to move on those islands in the South Pacific. I don't know when. I'll probably be dead. But it's going to happen, and all hell's going to break loose. And by the way, we have to build portfolios in preparation mentally that they can have a big drop in them. If you can't survive a 25% or 30% drop, you probably don't have the portfolio built correctly. And by the way, most of the time, these things never happen. Robert is spot on. That's the stuff actually that scares the hell out of me the most. I just don't know how to model it because usually it doesn't happen. So yeah.
Or it could be long enough that it doesn't affect them. And then you were prepared for something that never happened. And that's really hard.
Right.
Yeah,
that's right.
So the other question has to do with crypto investing. We've touched a little bit on this in the past, but it was a pretty open question about, can you talk about crypto investing? It continues to grow. I don't know what you have in terms of your thoughts on this. I will tell you there's so much happening in this space, and it's changing so fast that, and some of it seems super hokey, and some of it, and then flavors of it can be really applicable and very useful. But it's more than just a currency or a couple currencies out there. You're starting to think of it like tokens are actually access to things. I could see in the future. I mean, I talked to an estate planner last week who's thinking about redoing estate plans by not having estate planning documents, but by using decentralized autonomous organizations and having tokens that are given to each of the kids upon their passing. And then the rules are automatically built into the governing body of the DAO. Anyway, you can see there's a lot of interesting application, but there's also so much. You want to talk about zombie companies? Like, there's a lot of zombie activity going on in the crypto space, and it is really, really easy to get sucked into it. The cost of transacting was supposed to be really easy and really low and frictionless, and they call it gas fees are incredibly high to be able to transact and do things in this space. So it's not all it's cracked up to be, but there are some really special things happening there, and it's really hard. It's super early to try to predict exactly who's going to come out on top. And if you've got some money that would feel the same to you, of like dropping it in the toilet and hitting the flush, and you don't really care, like, then I would say go for it. There's some interesting things to watch, and it's always more fun when you own a little bit of it than when you don't. But other than that, I would be very cautious, very, very cautious about it. Kurt, what would you add to it?
Just keep it a very small percentage of your portfolio. And if you're right, it's going to get huge anyways. And if you're wrong, you only lost a little.
Right.
Yeah.
Right.
And I think too, the point of why we will be pessimistic with it is just because the reason its value is there is its perceived value. It's buyers and sellers are assigning it a value. And with these companies we talk about investing in, our stocks, we can point to metrics that say, hey, here's what's being made. With crypto itself, it becomes a little more difficult. So, but it's not to say it couldn't be in existence. It's probably why if you do put a drop in the bucket, you should probably be diversified to both the individual crypto and then probably companies that actually are going to make cash flow off of it. So there's just different ways to do it. But it's tough when it's like, why do you say that's worth $50,000 for one Bitcoin? And it's like, well, that's what this guy said in Coinbase.
Or a picture of a ape.
Yeah.
That's the stuff that starts to get really
arts.
weird.
Yeah.
Yeah. Anyway, okay. So I think we've covered most. We did have a question about silver. I'm going to type back directly to you on that one. And then I have a little quick disclosure, but I think we wrap up there. Thank you all for joining. We appreciate you joining these calls. They're a big deal. This will be recorded. Well, it is recorded. It'll be loaded to the website, so you can watch it later if you want. And then we'll send out an email with that recording. Kurt, thank you as always. We appreciate all the work you do putting this together. I know you do it anyways, and you just like talking about it, but we appreciate you joining us and sharing this knowledge with us.
I love it. It's always fun being with you guys. And thanks for bringing the bumper music. It just,
always.
It's like makes it a great call. So you guys are awesome.
Thanks, Kurt. We'll talk to you later.
Okay.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.